My name is Aleksandra Kaydzhiyska, and I'm the Executive Director of the European Association of Paritarian Institutions. We're very happy with the opportunity to present the main points of our recently published input to the European Commission's consultation on the renewed sustainable finance strategy. I'm very happy to be joined by Matthies, a representative of the Dutch Federation of Pension Funds, which is one of the members of AEIP that's very active on the topic of sustainable finance, and we thought that that would be a good opportunity to show some practical examples of the policy implementation process from the Netherlands.
Hi, I'm Matthies Verstegen. I'm advisor for European affairs for the Dutch Federation of Pension Funds.
Thank you. Could you please introduce the role of your respective associations in this area of European sustainable finance, please?
The European Association of Paritarian Funds is a Brussels-based advocacy organization which represents paritarian social protection providers as pension funds, healthcare providers, or provident institutions, which are managed on equal or parity basis between representatives of trade union or employer organizations. So this basically implies that within their managing boards, they always have an equal number of representatives of the two social partners, which then take decisions collectively around the operation, the management, or the structure of the fund. All our associate members are necessarily paritarian institutions. They're based in an EU member state, they're not-for-profit, and they're also long-term institutional investors. We have 29 members from 12 European countries. You see on the map anywhere where the EU logo is where our members come from. They provide coverage to around 18 million European citizens and have around 1.3 billion of assets under management.
Thank you. Regarding the Dutch pension funds associations, what is your organization and your role, Matthies, please?
Yeah, so we represent nearly all Dutch pension funds, and the pension funds in the Netherlands play a very important role in the pension system, which is a multi-pillar pension system. So state pensions are for everyone. They protect against poverty, but occupational pension funds really provide income replacement upon retirement. The system is called quasi-mandatory, so it's made mandatory through social bargaining agreements between the social partners. And this means that a vast majority, more than 85% of employees, are member of a pension fund and pay internationally seen quite a significant share of their wages into the pension fund. Together, the about 200 pension funds in the Netherlands manage 1,550 billion euros, which is about two times the GDP of the Netherlands. So it's quite a significant saving pot, and this results in really low poverty rates amongst pensioners in the Netherlands and high replacement rates.
Aleksandra, can you explain us what differentiates paritarian funds from other institutional investors?
It's very important to differentiate paritarian institutions from other types of institutional investors. It has to be noted that they cannot be considered as pure financial market players. They're active on financial market on the financial markets with a very clear social purpose to maximize returns for quality pension benefits. In that sense, specifically for occupational pension funds that we represent, they're seen more as an executor of a pension promise rather than as a provider of a financial product. In addition to this, they have a very long-term investment horizon, which expands with decades and is linked to their liabilities. And as a last point, they're also subject to their respective national social and labor law. Occupational pension systems across Europe vary to a great extent. Of course, this is a national competence. But the common denominator here is that for the occupational pensions in Europe, their main objective is to provide quality pension benefits.
In terms of the pension funds in the Netherlands, Matthies, what drives responsible investing in this area?
Yeah, I think responsible investing by pension funds in the Netherlands is a long-term trend that started already a few decades ago. I think some of the biggest Dutch pension funds are really recognized as international trailblazers in the field of ESG investing. More recently, we've seen regulation come in on for example, risk management and increasing the focus on that in that space. But in order to really be committed to investing responsibly, I think the motivation has to be more intrinsic. And I think in the Netherlands, it really comes from within the fund, the role that participants play. They are represented through their union representatives and employer representatives in the board, but there also are accountability bodies. And for example, with the biggest Dutch pension fund, ABP, they have an accountability body that specifically, or subgroup that specifically focuses on responsible investment issues. Because for a lot of Dutch people, their pension savings represent their biggest financial asset. So it is right for them to ask, how is this money invested? And this is also reflected in public debate. There's a lot of NGOs that ask rightfully to pension funds, what are you doing with the money? And I think this has really been, the driver of this trend of ESG investing for Dutch pension funds. Another driver of the idiosyncrasies between pension funds, I think the diversity in the sector. So you see very big funds, but also smaller, medium-sized, and smaller funds, and economies of scale in this area do matter. Pension funds try to invest, at quite low cost. So the bigger funds do have more capacity to have their own in-house ESG specialist. And another way this diversity manifests is in the identity of the funds that can be linked to the industry from which the fund operates. For example, in case of medical specialists or healthcare professionals, they might be more interested in policies around tobacco. And there are other examples of industries, sort of identities translating in ESG policies.
Thank you. And regarding AEIP, you have issued a paper recently on this topic of sustainable finance. Can you tell us where you stand and what is at stake for you on this matter of sustainable finance?
AEIP has been very active on the topic of sustainable finance. We provided input to all policy processes since 2018 and the first proposals of the European Commission. As our last action, we provided input to the public consultation of the European Commission that took place last summer. And we stressed several points in our feedback. Overall, we are very supportive towards sustainable finance and towards the European Commission initiatives. We see big opportunities in terms of harmonization of standards. We see that as an opportunity to increase accessibility of sustainable finance. And the transition in combination with proper pricing would, for us, create indeed new investment opportunities. At the same time, there are some remaining challenges for the implementation of the sustainable finance strategy and for the further mainstreaming of sustainability in the financial sector. So starting with probably the most important point for us, representing occupational pension funds and paritarian insurers, we see that steering policy through guidelines and benchmarks is definitely beneficial. But for us, the imposition of mandatory measures is definitely not the right way forward. Investment freedom is really important for paritarian institutions, especially for occupational pension funds. And there should be no instructions imposed on them on how they manage their investments. Again, they invest with a very clear social purpose. They manage investments on financial markets with the clear objective to ensure quality pension benefits and to match their liabilities in line with their social purpose. As a second point, we do recognize that ESG data availability, accessibility, and reliability remains an issue. Also when implementing sustainability legislation as the taxonomy regulation or the disclosures regulation, due to the wide variety and differences of different frameworks and data, at this point efforts are really hard to measure in terms of the concrete actions that companies or financial institutions are undertaking. So it's really important to have a consistent framework in place in order to ensure that legislation would be effective. In addition, there are really high costs at this point associated with accessing data or analyzing ESG factors. And this has big implications for smaller financial market players, specifically for smaller pension funds, for example. And these high costs are going to be reflected and transferred then to their members or beneficiaries. As an additional point, for us, the approach is key. So there needs to be really the right incentives in place. For example, in the technical expert group final report from March last year, there's a reference to possible next steps towards defining criteria for a brown taxonomy. And again, for us, that's not really the right step forward, because a positive approach from our perspective will have much more opportunities of creating the right incentives and engagement towards the common sustainability targets. At the same time, we're aware of the future steps on the social taxonomy, and for us this is really a priority in the work of the Commission this year, since for us the E, S and G are definitely part of the same integrated framework, and this needs to be reflected in the policy that the European Commission would be developing.
Thank you. Matthies, in your area of the Dutch pension funds, what is the state of play? What initiatives have been taken so far?
Yeah, I mean, before going into the initiatives, I think I should say that, you know, responsible investing is still in development, and more and more funds want to get more and more ambitious in this field. So, you know, I think there is focus on extending responsible investment into different types of asset classes and categories. And, you know, we see funds taking on different kinds of pledges and international initiatives. But there's two initiatives that we're really taking as a sector together with our members. The first is that we have an agreement with more than 80 of our members, representing more than 95% of participants in assets under management, to implement the OECD guidelines on due diligence and we call this agreement the International Responsible Business Conduct Agreement. And this agreement has been concluded together with social partners and NGOs. It's a 4-year project, and we're helping our members to implement the OECD guidelines on due diligence in their policy first, but then in their outsourcing agreements as well. And then as a second step, with a number of sort of leaders amongst our members, we are starting up cooperations with NGOs on specific engagement cases. So pension funds are coming together. They pick a case, for example, you know, labor conditions in the mining industry. They start an engagement track together with NGOs on the ground that can actually see whether, you know, the pressure being put on companies is resulting into changing behavior on the ground. And we think this is really an innovative part in engagement, and we hope this gets international traction too. Then the second initiative is a climate commitment. So, you know, in the Netherlands, we like to do things, you know, with social partners and broad societal stakeholders. So also Dutch climate policy is organized this way through a broader societal agreement on how to implement the Paris Agreement. And this financial sector has given its own climate commitment as part of that. So 12 of our largest funds representing, the number is growing. So I think it's at this point more than 60% of participants and AUM have committed to imposing, self-imposing CO2 reduction targets by 2022. But in fact, a number of them have them already in place. And they're also developing a joint CO2 reporting standard so that we can, you know, all compare the efforts conducted by the entire Dutch financial sector. So it's also banks and insurers. So we're working together on climate policy, as you can see.
Now, if we come to the challenges for both of you, starting with Aleksandra, what are the main challenges that you see going forward? You mentioned a few already.
On this slide, I included a reference to the recent OECD Investment and Business Outlook for 2020. They did a survey of institutional investors asking them the challenges and opportunities they see in terms of integration of ESG factors. I thought it's a good reference for us just to demonstrate how consistent the perception of challenges and opportunities are from the side of the sector. So on our side, they're more or less the same views in terms of challenges. So from a practical perspective, starting with the ESG data again, so ESG data accessibility is not really yet widely there, and especially difficult to ensure for smaller financial market players. I mentioned already the costs to make informed decisions and to analyze ESG factors and opportunities are still very high. And this is for smaller pension funds, for example, definitely going to reflect with additional costs for their operation, and is going to be ultimately transferred to their members and beneficiaries. At the same time, another challenge that we see is when developing the new regulatory framework at the European level, to ensure that all different contexts are reflected in which different types of investors operate. From the perspective of occupational pension funds, they're again active on financial markets with a reflection of their social purpose. So to maximize returns for their beneficiaries, they have very strict mandates, and at the same time, they're very, very risk averse. As a last point here from me, and maybe a more general point, so the European Commission is really attempting to ensure a full transition towards sustainability of the entire economy, or at least the major sectors of the European economy. So there needs to be definitely a level of consistency and complementarity in this approach. The financial sector is just one element, and definitely we see these different levels of decision making and different policies and different policy instruments that the European institutions have. We see this as a big challenge to make sure that they're again complementary to each other towards the achievement of the goals set in the EU Green Deal.
Matthies, would you like to complete on your side what you see as main challenges and opportunities in this field?
Yeah, I mean, I think there is, there is consensus amongst financial market participants that ESG data availability is a big challenge at the moment, in particular for implementing requirements stemming from the taxonomy and SFDR, but also, in order to basically be able to align the investments with the values of your participants, and to make sure that you actually achieve the responsible investment goals that you set yourself. So on the SFDR implementation, it is tricky that the EU chose to first impose disclosure requirements on the financial sector, and then only as a second step is looking at the non-financial sector through the revision of the NFRD. So I think that revision will be a real opportunity to assure that those data streams are aligned and the data becomes available at a reasonable cost as well. But also, if you look at the data that is currently being provided by specialist providers, there is not always a very strong correlation between the data sets, especially if you look at CO2 scope 3 data. So that makes it kind of hard to trust the data. So initiatives to improve that consistency in data, and also the ratings perhaps that are being given to companies, would really help to take ESG investment policies by pension funds to the next level. Then also, complementing what has been said already, a consistent holistic approach between policies for the financial sector and the non-financial sector, are really important. We need to have long-term policy goals for the non-financial sector in order to know what the transition paths will be and to invest in those transition paths over the next decades. If you invest for the long term as you do as a pension fund, it helps to know what the transition paths are for specific sectors. And then another challenge that has been met as well is that I think it's right for regulators and legislators to start to expect more from pension funds, but the focus is a lot on the E from environmental, and I think going forward, in the new strategy that's coming up, maybe there will be an element of expecting pension funds to consult or to ask their participants more in detail what their preferences are. And this is common practice already in the Netherlands through surveys and focus groups. But you'll see that a lot of the topics that come up are S topics, social, labor condition topics. So there is a big focus on the E at the moment, and it's right because the climate crisis is a crisis. But we need to keep in mind that ESG investing is broader than that. And I think if we're able to meet these challenges, the main opportunity is that we are better able to align the value with the values of our participants and invest the money accordingly. And secondly, find new investment opportunities. I think there is a lot of money there to be invested in big climate transition projects. But there needs to be the long-term certainty that and the economics of these projects has to work for pension funds to put their money there. So yeah, a lot of challenges, but a lot of opportunities too.
Thank you. That leads us to naturally to our last question. If you were both in an ideal world, if you had a wish list to give, what would be the main next steps that you would ask for in order to accelerate this rather positive ESG momentum that you have described in Europe? Aleksandra?
I have only one point here, but it's something that we would stress in all future policy discussions that we will have with the European decision makers. So for us, sustainable growth, of course, requires a fundamental change of all sectors and all aspects of how we operate. So there definitely needs to be a broad commitment on the basis of an effective dialogue with European institutions and impacted stakeholders. So in our view, involving all stakeholders in an effective dialogue is one of the basic points to ensure an engagement and then an effective implementation in the follow-up steps. So the more efficient the engagement process is with the respective stakeholders that would be impacted by the future policy and legislation, the more implementation would be effective from our perspective.
Matthies, on your side, yes.
Yeah. I mean, we of course agree with that point. And a bit more specifically, we've touched upon the taxonomy and identifying sectoral transition paths for part of the economy. This can be partly done by expanding the scope of the taxonomy, and we agree with Aleksandra that just having a brown taxonomy is something undesirable, because it could lead to sort of an informal pressure to divest from certain assets, and as a pension fund, you still need to diversify your portfolio to maximize your risk-weighted returns. But having a more broader taxonomy that could be, on a scale of 1 to 5, or from brown, light brown, gray, light gray, a more not such a binary approach could help set the long-term vision for which sectors to invest in and allocate to, and which perhaps to divest from. So that could really inform the investment policies of pension funds. And as was mentioned, the taxonomy ideally would also be expanded to a social taxonomy. Over the next few years, we expect that the taxonomy will be, it will be a tricky job to get it working and operational. But once it is, it could really be a game changer in the field of ESG investing. And then the second point is, we touched upon data availability. We need to come to a situation where there are consistent non-financial or ESG data flows between the real economy and financial market participants, so that we know and we can compare what we're talking about when a pension fund is deciding between different investment managers or different types of mandates. That would really help to inform that decision. But then when we're talking about information and communication towards participants or perhaps retail clients, we would urge that there is more room for tailoring this communication than there currently is. For example, with the SFDR, we are different because our participants are required to be part of the pension fund. So it's a very different situation than a retail client who is, proactively seeking to purchase a product, or that of an investment manager who may be CFA accredited, and currently the SFDR is treating all these kind of audiences as the same. So we are asking for EU policymakers to take into account, the specifics of each subsector of the financial sector, because I think only then, we can come to communication and decision making by different individuals that leads to more enthusiasm and interest in responsible investing.
Thank you very much, Aleksandra. Thank you, Matthies, for this very interesting and insightful debate, showing us the way forward and how IORPs can help EU sustainable finance to progress faster and quicker. Thank you to our audience as well, and we hope to see you soon on another Invest Experts video panel. Thank you. Goodbye.